Okay, so without further ado, thank you everybody for joining and for keep on joining. And yeah, let's get this started. So today, your hosts are me, myself, Daniel Falappa, founder of Equidam. Started Equidam in 2013, and just prior to that, had a master in finance and investment from the Rotterdam School of Management, and Mr. Giulio Tanganelli.
Hi guys, I'm Julia. I'm the council manager. I started as Equidam in 2020, so last year in February, and yeah, I'll be doing the demo parts a little bit later on in the presentation. I generally cover customer support and account management, so if you guys have ever spoken to Equidam via email or via chat, you would have been speaking directly to me. So I hope we're going to have a good talk today.
Awesome. So what are we going to talk about today? So today we're going to talk a little bit about Equidam, what we do, and who we are, basically. And then we're going to really talk about valuation. So we're going to talk about valuation for fundraising of startups, specifically in their early stages. How do we set the stage for a proper valuation, for a proper fundraising? How do we craft the story? How do we make the financial projections? How do we calculate the valuation on Equidam? That's going to be covered by the demo by Giulio. And then also, how do we negotiate valuation and the valuation report that Equidam produces, and a Q&A, as said, at the end. So really excited to bring you through this journey. So about Equidam, our mission is really help companies, help people understand how valuable their companies are, transparently discuss the value, and close fair deals with investors. And yeah, to date, we valued quite a bit of companies, more than 130,000 in 90 countries, in the 90 countries that we serve. Thanks also to our partners. We started in 2013, so we've been doing this for a while. And as you can imagine, we've encountered all sorts of things from extremely small investments to, I think our largest one was a valuation for an IPO on the NASDAQ of about 2.5 billion. So, kind of seen a lot of things, obviously not seen it all, but we're happy to share what we see in the market, what we kind of learned so far as best practices, and yeah, hopefully bring some value to your time today. Okay, so how does it start, right? When does really the valuation need start for the people that we serve generally, right? So there are two cases, right? The startup needs investment and to get the business off the ground, to really get it started. And the entrepreneur, the CEO, the CFO decide to start an investment round, start to look for funding. And then the question comes up, what's my valuation, right? The other case that we serve is the startup gets approached by an investor with an offer, and they either want to propose a counter, they want to check whether the offer is fair, they want to make sure everything has been taken into account in one of the transactions that is, they're super large transactions for early stage startups and very important transactions for founders, right? So they want to check on the valuation. So what now, right? And that's really like sort of where our story starts. So let's take a step back, right? And let's first of all try to set a bit of a foundation on what valuation is and why are we raising capital and that side, right? So a company, of course, is a risky investment, right? Risky in finance means that it has a variety of outcomes, right? It could go well, it could go badly, right? What we are trying to estimate is the value of the investment, right? And the value of the investment is really the amount that an investor or like a person or like the market, whatever you want to call it, the amount of money that they would pay for a return with a specific risk, right? So, and this is the first thing already that is very foundational, right? Is okay. Then the valuation is driven by two things, by two components, right? The return and the risk, right? So So the first question is, okay, so how do we solidify the valuation? And a lot of people ask, how do we increase it, right? But it's not, in my view, it's never been about increasing valuation. It's about, we want to show the company, as its best self in everything, right? In its marketing material, in its calculations, in its projections, but also in its valuation, right? So how do we then solidify the valuation as much as possible is going to be most of the next slides, right? But we see already that there are two components, right, for valuation, the return and the risk. And this is what we can act upon, right? So when we are basically crafting and setting the stage for the fundraising and for the valuation. The two strategies that we can adopt, right, are increasing the potential of the company, so increasing the return, right, or decreasing the risk, right? And what we see is that a lot of founders, a lot of companies, they focus way too much on the first one, right? They put everything under the sun into their strategy. Their market is the biggest market in the world. There's never been a bigger market. They're going to serve every customer on earth. And they're gonna it's just like the potential of what they do is unlimited, right? What we see working much better and at the same time being underutilized is the second part of the equation. So decreasing the risk of the proposition, right? And how do we do that, right? Like we try to show, so a company is always a bundle of risk, right? And the thing is that from the inside, a lot of those risks are already known and they are managed, let's say. But when we go and present generally to investors, but also internally to anybody, we tend to almost shy away from those risks, right? Which doesn't really eliminate them, right? It just allows people to make up their own minds on what's the status of those risks, right? So the first thing that we always advise is be upfront with those risks, right? Like a startup is always a bet, right? An investor, everybody knows it, right? So it's a bet on those risks. So the way to present the company as its best self is to show those risks, show that you are on top of them, show that you're doing the maximum that you can do to manage them, right? And absolutely not hide them, right? That's how you decrease at least the perceived risk of the opportunity. Then, of course, the opportunity is going to have its own risk, right? But this is what we see really, really helpful. And one of the main things to do this is to show milestones, right? So what we saw in valuation of early stage companies is actually the stage of the company is much more important than the industry, is much more important than the sort of the potential market, because you have everybody, an investor, everybody needs to understand how many and which ones and by how much have you confronted those risks and have you overcome those risks, right? And I mean, we all know them, right? Like product risks, market risk, hiring risk. At some point, if you want to get to if you want to be a unicorn company, you're going to have to go through all of them, right? And funding risk, right, is another one. And which ones have you done so far? And how do you prove that you've overcome them, right? Why do investors look for traction? They look for traction because traction already means that your product risk is relatively, dismantled, let's say, and your distribution risk, right? If you have traction, you kind of have shown that those two things are already, but they don't care about traction per se. They care about traction as a proxy to understand what's the risk of the company, right? And so why don't we show also all the other proxies, right? The company has an office, it has a product, it has a product team, it has the capability of hiring, it has a funnel of customers that are about to convert, right? All these things, all these milestones help decrease the opportunity. Having said that, right, when we go and prepare a funding round, right, we see that how do we solidify it as much as possible, right? So generally, this is what we found to be the best way, is coherence, right? So this is here on the right. So just when you set out for fundraise, right, you basically are presenting a story. And the story generally is told in three main documents, right? Your pitch deck or business plan, generally at early stage, a slide pitch deck more than a written down business plan, your financial projections, and your valuation, right? And why do I say like a story, right? Everything, because what you are pitching really depends on, yeah, it can have a different story. A lot of people don't realize that their story might be different than everybody else's, right? A company wants to be, wants to grow extremely fast, wants to be the next market leader of like global market leader of like a huge sector, right? Another company might want to be a niche focused, high margin, top performer in their country, right? And be bought soon, right? Another company might want to just create as many patents as possible. They like to do research. They're very smart in that. And, that's where they're going to stop. So every company has its own story. The important thing, in order to solidify the valuation and also to solidify just your, let's say, investment proposition for investors, is that it has to be coherent. Why? Because coherence is the best way to reduce the perceived risk, right? So we have the normal risk of the company that is just there, right? Like, global pandemic, right? But like things that can happen to the company. And then we have a second layer of risk, which is just what is called the asymmetry of information, right? Between what an investor or a reader of your documents knows and what you know, right? We want to minimize that as much as possible. That's just like useless risk, right? And that's how you do it. Coherence, coherence, coherence. And of course, like, everything else, there is work to do, right? So this one is just about your message, your story, how you craft it. All the business risk, you actually have to work on them, right? And try to remove them. So how do you craft, or like, what's the best way that we found to craft an ambitious story? And where do you start also, right? Because that's really the question, right? So for me, there isn't a precise way to start, but like what I think the best way to start is to start with ambition, right? What's the ambition of the founders? Again, do they want to make like, a lifestyle business, that pays their bills, lets them, buy a Ferrari or something. But that's it. Or do we want to make a global leader or not, right? And all of them have their merit. It's not like one is better than the other, right? It's just about, okay, ambition, right? What's the ambition of the founding team generally? And this one basically is going to reflect into a strategy, or it has to reflect. In order to make a coherent story, it has to reflect into a strategy, right? We can be ambitious. We want to have everybody drive electric cars, right? But how do we do that? We, like, famously, right? We start from a sport car, we moved into a sedan, and then we moved into the utility vehicle, right? That could be a good strategy, right? But then there is a third part, and that's the financial projections. So also the financial projections need to be coherent with the whole thing, right? If my ambition is to have everybody, using electric cars, but I don't want to raise more than 50K in the whole life of the venture, right? That's going to be pretty difficult. Or if I cannot hire people fast enough to make my ambition come true, that's going to be pretty impossible. So that's where financial projections become a useful tool to check the ambition, right? And it could even be like to increase it or to decrease it, right? But for sure to make sure that when you're going to get those questions, like, are you actually going to be able to sustain this growth? Or why not just, invest more and spend more money? Like those difficult questions. If you have thought about this and all three things are, let's say, in harmony and coherent with each other, that's the best way to present your fundraising story. It also allows us to have a very solid foundation for probably what's the most difficult part of your valuation, let's say, and of your fundraising strategy, let's say, which is making the financial projections, right? So let's assume that you've done this, right? So your ambition is, let's pick something else, right? Let's make a huge ice cream chain that covers the whole of Europe, right? You set up your strategy. You're going to start in a warm country, right? You're going to go by temperature, right? You're going to start from the warmest country and you're going to go down until you get to sell ice cream in the coldest country, right? Because that's the most difficult one. And your financial projections, and you get to, okay, how do I do my financial projections, right? You might want to start with one store, right? And then make sure that your store is profitable, maybe. And then you start your franchising business, or then you want to maybe own all the shops, right? So these are decisions that you're going to have to do, and that you can use your financial projections to check. How do you do that, right? Well, the best way that we found is to make the financial projections as a growth engine, right? So this is very important. Like, a lot of people, they have their ambition checked, let's say, they know their ambition, they know their strategy, and then, they pick an Excel file, they go like, okay, I'm gonna get, 5% of the market in 5 years. I'm gonna grow linearly. And I think I'm gonna need about 30 employees towards the end of the horizon to kind of cover this revenue, right? And what we see happen in that case is that, well, first, the projections are not very informative. They don't tell us, are you going to be able to sustain that growth? Do you have enough people? Do you have enough costs to sustain that growth? They don't allow us to plan. They don't allow us to answer questions like, what happens if this assumption is half of what we thought, right? So, so what we really advise people to do is to think about what's their growth engine, right? And in this case, like, okay, let's take, I think it's easier via example, right, to see it. In this case, let's take a SaaS company, right? Lots of companies are now SaaS. And this is just an example of a growth engine that you could have, right? But you can start with marketing spend. You have 10K from your uncle or something, right? To or even like 100 euros, right? Whatever. How many users are you going to convert by spending that much in marketing? Those users are going to convert into subscribers that are going to convert into revenue that is going to allow you to basically cover your costs and then have some profits to then again reinvest in your marketing spend, right? And what this allows us to do, if we manage to link as much as possible of the model on one or two or three, let's say, growth engines, is to tweak all these things, right? And to understand, okay, what happens if I double my subscription price, right? What happens if my conversion user to subscribers is not what I'm setting out to do, but it's like half of it or twice as much, right? And is this gonna work? The other question that this allows us to answer is this gonna work at scale? So of course, when I have one subscriber, right, I have a lot of overhead, right? My own, like, renting of the place to sleep is an overhead at that point, right? So, but it allows us to see that at scale, when we have like 1,000 or 100,000 subscribers, like, is it gonna work or not, right? Do we have to change our prices? Do we have to change our assumptions, right? And the other thing is that it allows us to tweak things, right? And ideally, on your projections, you would link almost everything to this growth engine, right? So, and I'll tell you why it's almost. But for example, right, and this is very model specific and company specific, and that's why we always advise to do this on Excel, because that's the most flexible tool, right? And like examples are, three salespeople per marketeer, right? Because the marketing is going to generate enough leads that three salespeople are going to be fully utilized, for example, right? So now we have a way to see, okay, when can I afford to hire another marketeer, right? I'm also going to have to hire 3 more sales. So much easier to see if I want to double the size of marketing, what's going to happen to the rest. one support or customer success person per 1,000 subscribers. These are just wild examples. Like, don't take these numbers as examples, but the logic, right? One manager per 6 employees, one marketeer per million of marketing budget, right? You need somebody to manage a budget. You could think of like, 50 engineers per product line, even though product line is not really a growth engine, right? But in case you could think about like one country manager per country that we open in, and then opening in different countries is our growth engine, right? According to how much money we have to open in a new country. So in this way, financial projections become a huge tool to make sure that everything is coherent. And this is the best way that we found to do this. How does it look in practice? Well, we're not gonna do a lot of Excel today. Sorry to disappoint some of you, but we have if you just Google Equidam projections template, or there are a bunch of valid ones online. How does it look in practice? Well, you can see here, right? We have an initial budget. Oh, that is not this. Is this an initial budget of let's say 20K that is going to grow 40% per year? This is our marketing budget. Is going to convert at a €1 cost per click into 28,000 clicks, for example, and so on. We have some organic traffic with an organic growth that maybe is proven by our historical track record, or is our average growth of the industry in the worst case, or something like that. This converts into organic traffic, which means that our total number of visits is this one. The conversion rate of a visitor to a paid subscriber is 1%, right? This gives us the total number of new subscribers, right? So already here you can see, right? I have like all these blue things are basically levers that I can use to again make my story coherent with my strategy, coherent with my projections. And on the cost side, so here there is a break, right? We don't have marketing stuff right under new subscribers, but on the cost side, we have, for example, of course, a salary, right, for the person, a percentage of growth per year of the salary. And then we have this, basically, we want to have in this model, we want to have a marketing staff every 150,000 visitors to the website. Again, random numbers, right? But this gives us a good modeling. When I was saying you almost model everything, is there are some things, especially in the short term about the strategy, that you want to show that are kind of almost like startup costs, like things that are not ordinary, right? So this is like this one marketeer every 150,000 visitors. That's your at scale kind of person, right? And another like thing that we like to show is like kind of supplemental stuff, right? So at the beginning, to kick off operations, you're gonna have to have extra people, right? And in this case, they are growing because the company in this case still has a plan to grow faster than its normal scenario, let's say. But you can play with this, right? But at least this whole thing is connected aside from your discretionary decision here. And this is where you can show an even tighter connection with your strategy. Like if you already know that something is going to happen straight away. Like, for example, we could have, an initial budget of like another 80K one time because we won a prize or a grant, right? That's a specific thing in your strategy that is nice to model. What else we show here? We understood over the years that there is a distinction between a fundraising projection file, let's say, and a budgeting projection file. So we see a lot of companies trying to pack both things in the same file and use their projections for budgeting and use their budgeting for projections. We saw that tends to complicate things for readers of the projection files. So it's either the projection file is too simple for budgeting, or the budget file is too complex for sharing with investors. So I think our latest sort of advice is to have them separate and to have the projections mostly yearly for 3 years, in case the company is more predictable for 5 or more. and have the budgeting file for maybe like, monthly for, 12 to 18 months, whatever. Also there, like, according to how predictable the future is for the company. But we really see that the separation of church and state is an important thing in this case. Another tip that we always give to people asking us is if you wanna use Equidum, if you do your projections for Equidum, if you just make a little tab for Equidum projections, we have a sample that we can send you and link it. It's gonna make your life much easier when you get and do the valuation, because your financials are already gonna be spec'd out with the Equidum categories. So right now, right, you have a good check, right? You have everything that you could check basically with yourself, right? You are coherent with your ambition, you're coherent with your strategy, your projections are coherent with everything else. In your head, it makes sense, right? So now it's time to kind of start the first outside test. And the first outside test is to see whether these final numbers that you end up with make any sense at all, right? So it could be that they don't, right? And how do we check that, right? So I think what we ideally check, right, is on a top-down checking. So like make sure that your numbers don't explode, and like the market needs to grow tenfold just to accommodate your projections. Like the market is not big enough for what you do. Those models have a tendency to go hockey stick and go through the roof a bit. So make a top-down check, and then if you have the time, but I think we advise also to always to do this. Just get, maybe if you can find it, a general benchmarking of the most critical variables, right? The most critical variables in projections are going to be your growth and your margins generally. And your growth, we have an article on, if you Google Equidum average growth rate, we have an article where we show an average of like the companies on Equidum, what do they forecast? And it's separated by industry, separated by age of the companies, and so on. So that's a little bit of an idea. But what I also always advise is like, check the fastest growers companies, maybe in your sector in the recent past. How fast have they grown, right? You can grow faster, right? But then you should double check that you have a good reason to grow twice as fast as the fastest growing companies, right? And then of course, like, I mean, if there are public companies in your sector, more or less, you can always take a look at their margins. There are reasons why the margins are like that. If you have extremely different margins at scale, maybe have a double check. Again, it could be possible you have a completely different business model or something. You manage for some reason to push twice the price to your customers or something like that. Or it might be that you're missing something and you want to double check that, right? So this is again an internal check, right, that you're doing. You don't need anybody else to do this for you, and you don't need to kind of confront your assumptions with anybody. It's just like you, right? Then the confrontation with other people is also always nice on this, right? So if you know somebody in that sector that can help you on these questions, if you know somebody, if you have a capital search party or an advisor, they help on these things. But the other thing is like, okay, for extremely early stage startups, right? Does it make sense to do all this, right? And to get bogged down in all this complexity, right? Well, yes and no, right? So like what we found is that projections at different stages of companies, at different company stages, have different targets, different goals, right? So when you like, and that's why like sort of you should double check how complex they get, right? Don't get bogged down in complexity at an early stage. At an early stage, so we're talking like seed, we're talking pre-traction, maybe we're talking early stages of traction. what the goal of the projections is not to be precise on the second, digital figure, decimal point, whatever. The goal, right, is to show your level of ambition, right? To show your budgeting skills, right? To at least show what you're gonna use the money for, more or less. To show your understanding of the market, right? So again, maybe that work of benchmarking is great in this, right? So if you can say like, hey, look, I'm planning to grow half as much as my competitor, but with twice the features, or with twice the customer happiness, right? That's extremely powerful. And of course also show the understanding of unit economics and potential of positive cash flow at scale, right? So at an early stage, we don't want to know how fast we're going to grow, how much money we're going to make with any level of precision, but we want to know that there is a glimpse of making profit at some point, right? That the unit economics works, or is going to work if these critical assumptions are going to be proven true, right? As the company matures, what does it mean? It like kind of removes more business risks, right? The company becomes more predictable, and then the projections need to be more precise, and they have the goal of showing how predictable the company is, of de-risking the perceived opportunity from a financial point of view, right? To show your growth engine and how precise you got it, right? So if you think about huge companies like Duolingo, I saw a presentation from Duolingo. They were optimizing the number of tiers in their owl logo, right, to bring you back and utilize Duolingo again, right? So that means that everything else was already done, right? So they knew their growth engine to the third decimal point, right? And they were testing that if they could bring it up by one, millesimal point, right? But I mean, again, right, when the company gets really large, but it's a scale of gray, right? And then the last thing that at a later stage the projections do is allow people on the buy side to calculate more precise valuations, right? So at an early stage, we want to get an indication of valuation. As we get more and more mature as a company, we're going to have a more and more precise financial investment opportunity for investors, right? So yeah, I think that's it on the projection side. I'm gonna give the microphone to Giulio, and he's gonna drive you through how to use those things in actually getting your valuation.
Cool. Can everybody see my screen? Dan, is everything clear?
Yeah.
Wonderful. So yeah, I think that's a fantastic segue into showing you guys the platform. This is the Equidam platform. This is exactly what it looks like when you start on the platform. I mean, we do have about a 10 initial question walkthrough before you get onto this actual page, which kind of allows us to do a bit of an initial estimate of your valuation, but this is pretty much where we get started. So I think the best way to start this presentation is to give you a bit of a lowdown of how we do the valuation itself, what methods we incorporate, and then from there I'll show you how to populate those methods and how the result looks like at the end. So how are we doing valuations? I think if anybody's had a look at the Equidam website, you can see that we're very kind of tailored to doing startup valuations, not the only type of valuation we do, but the reason why we are more geared towards startup valuation is because we use a blend of different methods. So we have DCF models, we have venture capital, we also have two qualitative methods that kind of look at your qualitative information as well. So by combining both quantitative valuation models and qualitative valuation models, we're getting a pretty well-rounded understanding of your valuation. The reason why we apply 5 different valuation models, as I'm highlighting here on the methods breakdown, is because valuation guidelines suggest to capture value from as many points of view as possible within the company. So what are these models and what are they actually assuming about your company? So we have our first 2, which are DCF models. These are your more traditional methods. They stand for discounted cash flow. They look at the future potential of the company, and by looking at risk and liquidity, we're able to kind of discount your future potential to a current value. So saying if your company is going to be achieving X amount of revenue by year 3 or 4 or 5, what does that technically mean your company is worth today? These are the more traditional methods when looking at doing valuation. We then also have a venture capital method. So we look at the required return on that investment. It kind of takes the standpoint of the investors themselves. And then we have two qualitative methods. And these qualitative methods originally were derived by, or were created by business angels in the US to be able to look at the company's qualitative information, look at its milestones, and understand the potential of future success of that company by looking at those qualitative milestones that the company has achieved. So what does each one of these models do is once they're populated, we calculate a pre-money valuation for each one of the models. So as you can see here, we have 5 different kind of pre-money valuations of the company. And we blend these 5 methods together using a weighted average system that kind of highlights the development stage of the company. So we need to take into what stage of development the company is in. I mean, the difference between a pre-revenue company and maybe a Series B company is quite big in terms of what it has achieved, its capabilities. So we're looking at the weighting here at the bottom is going to highlight that stage of development. The logic is that the later the company is, the more developed that company is, the more we're looking at its quantitative information. The financial projections are a bit more reliable as data at that stage of development, whereas maybe a pre-revenue company that doesn't have a lot of financial history, we're looking at its qualitative information a bit more heavily on the valuation. And once we weight these 5 methods together, according to that specific weighting, we then get your final pre-money valuation. So that's pretty much what the platform is doing. How are we getting to this result? What kind of information is evaluation looking for from a startup company? We gather this information from mainly looking at the questionnaire, which is of course the qualitative aspects, and then your financial projections, which is of course the quantitative. So the questionnaire on the Equidem platform is very straightforward. I think on average, I see clients taking between anywhere from 35 minutes to about 50 minutes to complete this. It's not very complex, but in any case, we also have a chat function, as I mentioned before. If anybody's ever spoken to us through the chat function there, you would have spoken to me directly. So we do have that to help along the way. But looking at the actual questionnaire, what kind of questions are we asking? We're looking at 4 main aspects of the company. We're looking at the team. So how does the team kind of affect the company's performance? What kind of experience does that team have? We look at the business model, how the company has been set up, what kind of venture is available. We look at the product and market, so understanding how competitive is the company, what market is the company actually kind of performing in, and then we also look at what IP is maybe applied to the product and service, and what kind of legal status is the company in. The questions range within the team. We look at the founders, we look at the entrepreneurial experience of the founders, how much committed capital have they inputted into the company so far. We look at the core team, so we look at the relevant kind of industry experience that the team has, managerial and business background, technical skills. So we're really trying to value that team almost as if it's an asset to the company, right? Your business model itself looks at things like scalability. We look at the stage of development, which is what was affecting the weighting that I showed you guys before. Break even, what kind of board of advisors is there in place? Is there a formalized board? What kind of exit strategies are offered to the investors? So I think within those first 17 questions, you can really see that we're trying to get to that really important qualitative information that is indicative of kind of future success. Product and market, we look at what country the company is based in, we look at what industry the company is based in. This is very important for the platform because this is what's automatically going to populate the platform with your country and industry specific parameters. So things like country are survival rates, things like industry based are your EBITDA multiples. So it looks at that important parameters to set the valuation by, to make sure that the valuation is applicable to your country, it is applicable to your industry, and we are trying to granularize our results a bit more. And the rest of the product and market section, we look at things like total addressable market size. We do have an article that talks about how to calculate the TAM. Annual growth rates of the market, as Daniel was mentioning, is very important. And then we look at kind of competitive environments. So we look at how competitive is your company, what kind of competition are you experiencing, whether it's international competition, domestic competition. Do you have the ability to expand and compete on a more international basis? So looking at the company's capabilities there. And then within other parts of the product and market, we look at things like degrees of loyalty of customers. So what's your client retention looking like, which is also an important piece of information. Key strategic partnerships that we maybe had within the industry to better the company's development. And then we look at IP and legal. So what kind of legal entity has been incorporated in the company? When was the company started? And then we also look at the intellectual property. So what kind of intellectual property applies to the product and service? And what stage of development is that intellectual property in? So it's just a quick 36 multiple choice questionnaire. It's not, as I mentioned, especially if the founder is inputting this information, it really shouldn't take that much time. The financial projections is, of course, the next step in the process. So we look at, I think, Daniel, you mentioned that we generally suggest to do about 3 years of financial projections, anywhere between 3 and 5 years. So yeah, just to kind of give it a bit of a basis, we do have a currency selector, so you are able to change the currencies, also convert numbers at a specific conversion rates in case maybe you're in Europe and you need to go to an investor in the UK, you can always just change the currency quickly. And then we have 1 past year of data, and then we have 3 years of financial forecast. If the company is pre-revenue, you're completely fine to input zeros across the board. The platform is designed and tailored to be able to value pre-revenue companies, so that's not a problem. But the more important is the 3 years of financial forecast minimum. We do have a button here where you can add more years, so it is quite straightforward and easy to be able to add more years if the company needs. Now, looking at the actual inputs, I mean, they range from revenues, cost of goods, salaries, other operating expenses, EBITDA, your taxes, net profit, all the way down to your free cash flow to equity. And at the very bottom of the projections table, we also have a last available balance sheet to be able to highlight any assets or liabilities that the company may have applicable in this situation. Now, one of the things about Equidem is we're trying to really provide a lot of transparency to the valuation. I think that that's a very important part when doing valuation, especially for companies who've never done valuation before. So one of the cool aspects that I love showing people about the platform is that we do have an embedded tool that shows you as you're inputting data, how that data is affecting your valuation. So I've just raised my last projected revenues by about 100,000. And you can see how that small change in information has affected the valuation of the bottom line, which methods has it affected. So we're really trying to provide a bit more transparency and understanding around valuation with the platform. Oh, sorry, I'm going to move that. So those are the 2 main data inputs in terms of what populates the valuation models. We then have a transactions tab, which looks at the financial, funding round that the company is trying to go through currently. So we look at capital needed. In this case, we're trying to raise $1 million. I hope that we make it. And then within the rest of the platform, we also allow you to input a bit more aesthetic information, a bit more contextual information about the funding round. So we look at use of funds. It is a nice way to be able to open up kind of conversations about strategy for the future with investors, looking at how the money is going to be injected into the company, as well as looking at any past funding rounds the company may have gone through as well. Pretty pertinent information for the report. And I mean, once these 3 main data inputs have been produced, we can get back to our dashboard and see the kind of the result, the output of the platform, which is your final pre-money valuation here. So this is where we started the conversation. I think it's going to make a bit more sense now looking at it, how the models have been populated, how the weighting affects the actual kind of combination of all 5 results, and how your pre-money valuation is developed at the end of the day. And as well, we also highlight the 1 million capital needed, and we also highlight the kind of the fair market price of percentage of shares to be sold in exchange for capital. So that's also something that the platform is computing. Anything past this, we have a company profile section. So we're looking at the aesthetic information of the company. We have company name, we have business description. So looking at a bit more of that aesthetic information, you can populate it with a logo, color of the report as well. And then we also look at the competitor section and the shareholder section of the company to be able to kind of highlight this in the report. So what have we done? We've inputted qualitative information of the company, quantitative information of the company. We've highlighted the capital funding round. We've done a bit of a company profile. The only step now is to kind of look at maybe the advanced settings tab. So this is something that we only really suggest clients to go through if they have an advisor on board that can help them understand a bit better the market. But you are able to customize the weighting of the 5 methods. We don't really suggest deviating away from that unless it's a special case. Maybe it's a very established company. You only need to do a DCF model valuation. We do provide a bit more transparency with the tool. And then we also have the methods criteria, where if you do have more granular information about the market, you are able to maybe change those base parameters like your EBITDA multiple, like the survival rates, or maybe a liquidity discount. So, I mean, again, the transparency of the platform is really, it's really what we're trying to highlight here. And then the report section of the platform is where you're generating valuation reports that highlight everything that is currently inputted onto the platform. The reports are generated pretty much in real time, so it's just a matter of clicking generate report. And then as you can see, the platform puts it together pretty much in just a few seconds. Once the reports are generated, you do have a history here at the bottom of all the reports that are made. So you can keep up with the reports as they're going through. You can see how the valuation is evolving over a certain period of time. You can also play around with the information that's being inputted, so maybe more kind of aggressive financials, a bit more conservative, to see how that's going to affect your valuation, understand how best to negotiate with investors. And then looking through a report together. Wonderful. So yeah, this is the report. We try our best to kind of pack it with as much information. So we have your first company logo and name. We have a company summary, so we just kind of pull a few aesthetic information pieces from your inputted data. We do a bit of kind of forecast analysis. So we do look at the future profitability and cash forecast of the projected years. We highlight things like past funding round, current ownership. So it's all really transparent to be able to have a nice and open discussion with investors. Then we get to your valuation pages. So we do highlight the pre-money valuation of the company, the method. So pretty much what you saw in the dashboard, the results of the platform, as well as your current funding round. So of course we highlight the capital needed, the percentage of shares to be sold in exchange for that capital. But we also give you a low bound and a high bound, which is a bit of a margin on either side of the results to be able to kind of give you an understanding of what's fair in the situation. So you know that maybe going into the investment round and giving them 25% of the company for $1 million is a bit kind of out of line with what is fair. So it's a good way to be able to understand how to negotiate. And then we start deep diving into how we're doing valuation, which is very important when discussing it. We need to be as open and honest as possible. So we look at your qualitative methods, highlighting the parameters, the criteria of those methods, the checklist method as well. So again, just kind of really giving you in-depth analysis. We look at the qualitative trait summary. So these are answering your qualitative responses from the questionnaire at their basis. So you can leverage that good, important qualitative information about the company. And then we have your VC method and your DCF models. Here we highlight the full flow of how they're calculated, all of the parameters of the methods themselves. You can highlight the discount rates, the survival rates that are used in the DCF models. Very transparent to be able to understand exactly how your company's been valued, not just at what it's been valued at. Your financial projections, of course, we also highlight your profit and loss table, and of course your cash flow. And above this, we have an appendix section which dives a bit deeper into Equidem's methodology. We highlight things like our data sources for each one of the parameters that we gather, how often they're updated, the weighting of the 5 methods. So again, it's even easier to understand exactly how Equidem is doing valuation. And then on your very final page, we have your last available balance sheet. Yeah, and that is the Equidem report.
Awesome. Thanks, Julio.
Not a problem. Thank you, guys.
Thanks a lot. I think that's maybe like 2 things to add on that is one, you can always go back, change the data and make a new report. And that's why I was mentioning to have like an Excel tab, like a tab in Excel about the Equidem financials. So the financials in the Equidem categories, basically. And the other thing, just because it's important, is not that much the growth of the market that is important, it's the growth of your projections. Growth of the market, we saw that is, I mean, relatively unimportant in the sense that, you know, some markets are just even created by the startup. So we want to have it as a check, but the growth of your projections is important. And just quickly, since Nevena asked, the document is online on equidom.com. On the menu, like we have it on the menu. I don't know the specific link. Maybe Dan, you can link it in. Ah, there you go. Okay, so just to get back to the last part of the presentation, I just wanna go back to share my screen again. There you go. So okay, so now we've done, right? We crafted our story. We have we have everything ready. We have our projections ready. We've done our valuation. We have a report, right? What do we do, right? And sort of like, what are the tips and tricks there, right? Of course, like the next step is to negotiate the valuation, right? So you don't, like, it's always a negotiation, right? It's always a discussion, right, with capital providers, right? So a lot of people sort of ask us, like, how do we negotiate the valuation? That's a very, like, sort of extensive question. But what we saw as main pointers are on how to negotiate the report, right? Well, and the valuation. In general, what we tell startups is to tell the truth, right? Which is that the valuation is uncertain and difficult, especially for startups, on both sides, right? On the investor side, on the startup side. Of course, investors do it much more frequently, so they have a much better grasp of what's the price of things in the market, right? And this is like something that people don't think about much, I think, which is that the price of things just have a price in relation to other prices, right? If you think about a can of or a bottle of Coke, right, that now is very famous, right? If you see it next to all the other beverages, right, it has a very precise price. But how much is it in the middle of a desert, right, when you don't have any other source of drinks, right? So and for these startups, they're not really comparable. So valuation is just uncertain and difficult on both sides. What we suggest is to present the report as it is, so the result of a professional process, as professional as, you know, it can be done, as the result of a serious process that, of course, has uncertainty in it. So, you know, and to be open to feedback on the valuation and on the report as well. The other thing is that the valuation itself is the result of a calculation, right? So if there is a huge discrepancy between the valuation that an investor is thinking about and the valuation that an entrepreneur is thinking about, well, the report should allow to check what are the different assumptions, right? What don't we believe about this? Don't we believe, you know, maybe the multiple of other companies, we want to change it. We don't believe the growth. We don't believe the margin. We don't believe the risk. We don't believe that the company has already, like, we believe that the company is much riskier than what it is, or much less risky than what it is. So it's just about coming together on the assumptions, right? And the other point is when to discuss valuation, that we often get asked. And the tendency that everybody has is to leave it for the last item when speaking with investors. And like, sort of what we gather so far is that we think that is an okay strategy if the investor is trusted. So if they have a good reputation, or you've known them before, or you know, like, they have a reputation as well. They want to get into the best deals over and over the years. So they need to maintain a good reputation, right? In that case, they'll try to work with you on a valuation that is fair for both, right? And in that case, it's okay to invest the time to discuss all the other things and then kind of leave valuation for last. If you don't know their reputation, if you don't know their way of thinking, if you're not sure they're used to maybe to startup investing or to software investing or something like that, maybe it's better to bring it up early on. And if you're really doubting, even just as one of the first things, to just make sure that you're not going to waste a lot of time in talking about other things, and then have a valuation that is, you know, 1/10 of what you want to accept, right? I just wanted to pull up the participants. Okay, and so yeah, so this is for when to invest, right? But the other thing that I think a lot of, especially entrepreneurs, like we talk over, like the 90% of the people that we serve are actually on the startup side. So founders and CFOs and entrepreneurs. So a lot of what is misunderstood, I think, is the investor point of view. So a lot of times it's not about, it's not about not investing in your company because it's bad. It's just because, there are multiple opportunities. So, this might be not the best opportunity in a sector, not the best opportunity for them. So, in that case, right, like they are looking at what's your distinguishing factor among all the other companies, right? The milestones, as we said, extremely important, right? To decrease the opportunity. How are you going to prove that you are going to be the company that takes over this amazing market, right? And this is also like in the founder knowledge and ambition, right? There needs to be a fit as well there in terms of the story and the projections, again, right? Coherence and everything, and then the return as well, right? The investment opportunity should be an opportunity, right? Should have a good return on the investor side. So what does this mean in the end, right? And this is something that we think is very important, is that the fundraising itself is an iterative process, right? So present, listen, modify, repeat kind of deal, right? Why is this, right? And a lot of people think like this is unfair, right? I know the value of my company. Well, you are the sell side, right? And you're making assumptions about the buy side, right? If you don't ask, right? So until you ask, you're going to have assumptions on what's the appetite of the market for this deal, what's the appetite of the market for this deal at this price, right? What are the most current prices? Again, everything works in coherence with everything else, and as well as, am I making some huge fallacy, right? Or am I missing something, right? Investors, they kind of think all the time about opportunities in a sector, right? So they see 5 other companies in the same sector, right? So especially the good ones, and I'm by no means, saying to listen to every advice, but like, it needs to come together, your story and the appetite of the buy side, in order to close a deal. So that's why, like what we see and we generally advise is like, okay, maybe present your opportunity to not straight away to your top investors, right? Maybe to something that you consider maybe a good investor, but not your top pick. See what's their feedback, right? Adjust everything, right? Adjust your ambition, your story, your financials, your valuation, and repeat. And at the end, you're going to have the most solid story, the most solid chance at the funding round, and at the most solid valuation possible. So yeah, with this, I think we are done for today. Yeah, me and Giulio, and also Dan, that organized the whole workshop. Thanks a lot to everybody. You can find us on LinkedIn. All of us, you can follow us on the blog. We have templates. We have a lot of templates on equidam.com/support if you're interested. And I think the links to the templates that we spoke about are in the chat right now, if you want to grab them straight away. Otherwise, we'll anyway send follow-ups afterwards. Just as a reminder for whoever joined not from the beginning, if you're interested to listen to the rest, we will be uploading a video of this at some point, and we'll inform everybody that registered via email that the video is up. So you're going to be able to listen in from the beginning. And yeah, I hope this has been useful. And yeah, we open it up for questions right now. If you want to post your question on the chat, we'll see how long we'll be here to answer, basically. But let's see a bit how it goes. And okay, seems like, okay, so the last question, just quickly, in pricing of specifying convertible terms. Yeah, so that's a good question, right? So that's what a lot of people think, that by doing a convertible note, you basically avoid all the questions. about pricing, and you really don't. And you get to to try to calculate a valuation as well. So we have a tool. If you Google equidom.com/ I don't know, if you Google convertible note tool from Equidom, we have a tool online. And what we show there is kind of what our respondents have answered to, like the cap, how they set the cap versus the next round, how they set the, what was it, the interest, I think, that we show there. So like a few pointers on how to set things. It looks like convertible notes are used in two occasions, either as a bridge round to kind of bridge the gap to a Series A or something very close by. And then in that case, it's more like a loan almost, and the conversion cap is close to the value of the valuation right now. And on the other hand, people use it as a true funding round, and then the cap is closer to what they think they'll be able to raise the next round. Yeah, it's an interesting instrument. We generally, like, our general advice is it just hides a lot of complexity. So if, now that you know how to do valuation, like, I would almost say do the valuation instead of doing a convertible, and then do a straight up equity round. Yeah. Any other questions? Awesome. Then everything was clear. I don't know, Dan or Giulio, something that we didn't cover that we want to cover more?
I don't think so. I think that's indicative of a good presentation.
Awesome. Then thank you, everybody. We're always available. We're always available at info@equidom.com as well. So feel free to send us your questions there.